All right, welcome everybody to Pups Office Hours. It is Wednesday, May 11th, and we have a full-on bear market. So we'll get into the indexes, some of the ETFs, and some charts that I wanted to highlight and go over. But before we do that, let's just talk a little bit about today's agenda. So I'm Denny Naz. I've been a full-time trader for the last few years, been in the markets for over 8. And this is my office hours. So we're going to run about 75 to 90 minutes. We're going to do a market overview, post-market process, hunting for trade ideas, building watch lists, setting alerts, et cetera, et cetera. And of course, as always, for those of you who've been with us, if you have any chart requests, please drop them in the chat. If you have any questions, please drop that in the chat as well. And what we'll do is I'll go through all the charts that I have set up for this evening. And then we can talk about the chart requests and do our Q&A session. Of course, always want to thank my software partners. I'm doing all my charting with TrendSpider, and my options platform of choice is Black Box Stocks, and I use TradyTix for my algo trades. And for those of you who are not familiar with my platform, I do run an educational platform where I send out daily emails with market updates, economic data, any earnings that are coming up. It seems like there's earnings on all the time now, so there's always an earnings happening. And of course, my long-term conviction trades and my scans and watch lists, my trading rules and documents, chart requests if you need them. Of course, this office hours that you're on currently are watching, that's going to be every 2 weeks on Wednesdays, 7 p.m. Eastern Standard Time. And then, of course, I always do my weekend video where I go over my top 10 to 12 charts for the week. That's going to be 79 a quarter, 275 for the year. And then, of course, I have the executive plan, which includes one-on-one time with me where we can go over anything that your heart desires. That also comes with lifetime access to my Fibonacci course, which I'm glad to say is about 75% done. I'm hoping very, very soon to launch that. And of course, you could always catch me on Twitter. So bear with me while I get my charts uploaded here. So stay with me for a second and we will dig into the charts. Okay. So what I was saying earlier, we had a 5-week drop right here. It was basically a month and a week. And we had a 5-week drop here off of the recent highs. Let me get my drawing tool up here. They used to have this vanishing drawing tool, but I guess they took that away. In any event, so we had that COVID drop. And now we have a very similar drop here, although it's not as exaggerated. This was a 35% drop in 1 month in 1 week. This is a 15% drop in 1 month in 1 week. But if we look at the move from the all-time high to today, we're at about 18%. So 20% is right down to the 618 retracement, which is at 383. And that's also our COVID low anchored VWAP. So I think very likely that's where we're headed. We may see a bounce, today and tomorrow, or tomorrow and Friday. But I think ultimately this market is looking to test these COVID lows, which we haven't seen a test of since April of 2020. We've basically been up off that COVID anchored VWAP since then, and it's likely that's where we're headed next. Now, I'd love to say that that's going to be the bottom. I don't know, if I'm being completely frank and honest. I do think it may be a bottom, and we may see a counter trend rally like we generally see in bear markets. We're seeing, this 3-week rally right here that tried to overtake these prior highs, and it failed, right? And in essence, what that failure created was a left shoulder, a head, and a right shoulder. And then basically there's your neckline. And so we're breaking down off of that neckline. And you could see we broke down first here, and then we retested and tried to break back above and failed. And now this is just our continuation lower. So I do feel like there is more pain ahead for SPY. very similar for the Qs and IWM, but not necessarily for everything. And I think that's what we'll talk about a bit this evening. So let's take a quick look at the Qs. The Qs definitely have been weaker relative to SPY. It's tech, obviously, for anybody who's in the market, we've all been doing really well with tech stocks over the last couple of years, more than a couple of years. I mean, basically since the housing bubble burst in 2008, tech has been on a monster run. And now I feel like tech has been at its weakest ever since then, and certainly ever since the tech bubble burst back in the early 2000s. And so, I did have an initial target here of 297, basically 297 to 300. And we came right into that last week, bounced right off that top. And then this week, we just obliterated that target. And now we're headed down to my second target. So we've already lost the COVID low, as you could see here. And if I zoom out some more, I go back to the 2018, that was the week of December 24th, the 2018 low. That's this that's this anchored VWAP right here, which is under the COVID anchored VWAP. And that's basically right below our 50% retrace on the Qs, which is at 286. So I'm fully expecting us to come down more on tech, possibly between 280 and 286. And honestly, if we do lose this 2018 low, we have that 200 SMA, which is, it's another 30% or 30 points lower. So, the one thing I'm noticing, though, we are starting to get a bit oversold on RSI. And you can see back here when we hit that 2018 low, we also were right at that oversold level. And then the prior low to that, sorry, that was the COVID low. The prior to low to that was the 2018 low, which we were oversold, and we're right there as well. And so this low is looking very similar to that 2018 low in respect to RSI, where you could see here, we kind of had this meltdown, right? Came down very close, it bounced, it came back up to 50 RSI, got rejected, and came right back down, right? Very similar here. You have a kind of a three-stage meltdown, came back up to RSI, failed, and now we're back at, that oversold level. Now, history doesn't always repeat itself, but it generally rhymes. And so when we hit this low right here, we saw a nice rally back up to the prior highs. And so that's something I'm watching for, certainly. I'm not saying that's going to happen, but it's certainly a possibility. But I don't think the odds are in our favor, just keeping in mind the macro environment that we're in right now. The war in Ukraine is still putting a lot of pressure on oil and gas and fertilizer stocks, wheat, certainly, commodities, obviously. That coupled with COVID shutting down, China again, that's going to add more supply chain issues, and, outside of all of that, inflation. Listen, we from 2008, we've been spending our way out of everything. And with COVID, I posted a US debt chart, I think yesterday, or maybe it was earlier today. And, we've just been continually to spend money, and, the chickens are coming home to roost. We only can get away with spending money as much as we have been for so long. And now, of course, we had the Fed signaling that, based on CPI data, which didn't look that great, they're probably going to do another half point, maybe even a 3/4 point raise this next time around. And so they're aggressively coming after inflation, trying to get it under control. And their answer is to continually raise interest rates, which puts obviously pressure on housing and puts pressure on inflation, but so far hasn't really made a dent. And so we're likely to see more raises throughout this year and possibly into next year. So although I digress, I'm looking at potentially 280 to 286 of being a short-term bottom on the Qs. And if not, I think it's very possible we can come down to the 258 to 260 range, which is putting us right at our 200 SMA. And if we go back in history, we've never tested, or I want to say never, we haven't tested that level until since 2010. So it's been 12 years. It's a really, really long time. And we came pretty close in that 2015 bear market that we had. But yeah, I mean, this is obviously a bit of a different monster here. You know, we've had a big accelerated push to the upside, which, you know, you can't go up forever. And now we're getting a drastic pullback. So I think that's what we're dealing with right now. Let's take a quick look at IWM. So IWM small caps generally get hit harder than the bigger indices. Yeah, I mean, it's not looking great. We had this failed breakout up in November. We had a 3-week breakout, and it's been nothing but a downtrend since then. Potential ABC retracement here, right down to the 50% retrace at 170. This level does look interesting because we were at the prior resistance here on January 13th of 2020, right before the COVID drop. So that's pretty much where we are right now. We're right back to where we started right before COVID. So it's definitely sitting on an edge, right? It's looking very precarious here for small caps. And then if we look at VIX, this is VXX. All these spikes are basically, volatility spikes that we saw, as COVID started to wane a bit. And now we're starting to see volatility, increase again. And so that's creating just, wreaking havoc on the volatility market, which is, if anybody's been watching the intraday moves on the charts for the last couple of weeks, it's a nightmare. I mean, prices are up, down. I feel like, the indices are trading almost like penny stocks. I mean, it's just so volatile. So yeah, it's just a really, really tough environment to trade right now, and certainly a tough environment for swing traders. Certainly there are day traders out there that thrive on a volatility market, and there are ways, using options to capture, but you've really got to know your stuff, and you've really got to be quick and nimble on these trades. And I can tell you that it's even difficult for those traders as well. So that's pretty much, the main indices. What I'm going to do now is go over some of the top sectors. Really, in all honesty, there's only one sector that's been outperforming the market, and that's energy. To no surprise, oil prices hit, all-time highs or 40-year highs. Gas prices are at the highs over the last 10 years. Natural gas is high. All of the energy sector, a lot of it, again, has to do with the war in Ukraine and energy prices, but also partially due to inflation and supply chain issues. It is a perfect storm right now in this market. But you can see right now, we're at Wednesday, we're halfway through the week. We're putting in an inside week here on XLE, which is our energy sector. The top holdings here are going to be XOM, which is ExxonMobil, CVX, Chevron, COP, ConocoPhillips. But if you look down the line, if you look at the oil and gas market, if you look at the producers and the suppliers to the industry, most of those markets are doing fairly well, although it's been a bit more volatile the last few weeks. We've basically shot back up over the last week and a half. And we'll look at some individual names, certainly in a bit. Let's take a look at utilities. Utilities was running fairly well, but this has also come down. And something I've noticed here, we had a 14% drop on this drawdown, 7.5% drop on that drawdown, almost a 9.5% drop on that drawdown, 10.5% on this drawdown. And if we look at what we're at now, we're just at about 9.5%. So I think if you take the median move on these drawdowns, it's probably about 10.5%. So I just did some calculations, and we do have that 50 simple moving average, and we have the 618 at 69.24. So certainly utilities is something to keep an eye on in the next 2 weeks to see if we do bottom out on XLU in that 60, I would say $68 to $69 range. If it does, and we start to bounce like we did and had these counter trend rallies here, then I would look for some of these names: NEE, DUK, SO, D for Dominion. Those would be some of the names that I would be watching for utilities if we do see utilities move. Next up is the materials. This is XLB, Sherwin-Williams, SHW, Freeport Macaroon, which is a copper play, FCX, Newmont Corp, NEM, DuPont, Dow. So these are some names that I've talked about over the last few months. And you can see we're pretty much trading in a range. So what I would watch for this is watch when we come to the bottom of this range. Watch when XLB comes down to probably around 78. Again, do we get a bounce there? If we get a broader market bounce, then watch for XLB. Watch for some of these names to also bounce with the market. Let's take a look at consumer staples. Procter & Gamble, Coca-Cola, Pepsi, Walmart, Costco, Philip Morris, all, consumer staple products that are generally used by the broader market or by the broader consumers. These are things that people are not going to stop buying, no matter how good or how bad the market is. And we saw a nice run in the consumer staple market up until we hit this top. And then the last 3 weeks, we've been selling off. So again, 13.5% move higher, pullback. 14.2% move higher, pullback. 13.3% move higher, pullback. And so, we could take a quick look and see, this pullback was 4%. This pullback was 8.5%. And then so far, this pullback here to that 1618 extension is about 6.5%. So again, keep an eye on consumer staples. Again, they're not going anywhere. And if the market continues to sell off, some of these names are going to be, basically people are going to flee to safety. There's going to be a flee to safety on the consumer staple names. So let's move down the line. This is XLV. This is healthcare. And, with this one, here we go. Just want to pull that up. You're looking at Johnson & Johnson, United Healthcare, Pfizer, Abbott Labs, ABBV. We had a great trade on ABBV. We'll talk about that, I think, in a little bit. Yeah, this one, it's coming back down into this orange band, which was prior resistance before breaking out, turned to recent support. And you could see all these wicks, these weekly wicks through this level. We're in that level right now. So if we fall below that level, certainly doesn't bode well for healthcare. But if we start to bounce in the broader market, I would again look at some of these names for a bounce higher. Healthcare is not going anywhere. And so this could be a sector where we might see some relative strength. Here are financials. So financials really has not been great. It's been coming down with the market. But again, I wanted to highlight some of these levels that we all should be watching. So here back in, let's see, this is that's January of 2018. We hit an all-time high of $30.40. Then in December of 2019, we broke out. And then right for COVID, we gapped below that level and then just sold off. And obviously, like most of the market, financials have made a nice steady move back higher. And now we're coming back down. So, we have the 618 retrace from this swing low down here to this swing high. We have the 200 simple moving average on the weekly. And we also have that prior area of resistance all in one little zone right here. And so what I would expect is potentially financials to come down to this zone, to this level. This would be the area I would watch for a bounce. And again, you're thinking Berkshire Hathaway, JP Morgan, Bank of America, Wells Fargo, Morgan Stanley, Goldman Sachs. And you could also see that we had a 4-dot squeeze fired on the TTM squeeze. So that's already 4 weeks in. We potentially could see another 2 to 4 weeks of downtrend in financials. And look at where RSI is, right? RSI is not even oversold yet. And you could see on the COVID low, we were drastically oversold. So definitely more pain looks like it for financials here. Let's take a look at XLC. These are your communication stocks. So Facebook, I believe, is a pretty heavily weighted in here. I think it's around 22%. You have Google, parent company, Alphabet. Netflix obviously crushed in the last couple of weeks. Charter Communications, Comcast, T-Mobile, Disney. We all know these names, communications being absolutely hammered, but look at where we are, right back to prior resistance back in right prior to the COVID high, which then turned into a breakout, back test, prior hold, resistance turns to support, and we had our big March higher. Now we're right back to those levels. So wanting to see, do we hold these levels here and bounce? Because certainly we're oversold. Look at the oversold conditions that we're in here, right, from COVID low. We hit that here, and then we bounced, and we're back here. So do we get another bounce? More than likely, we're getting a bounce soon. The question is it a counter trend rally like we see here and here, and potentially see here? And if it is, we go back lower, or is it a bottom forming and then we push back higher? Again, no one really knows. We just have to watch the market and play these bounces accordingly. And so that's really, outside of those charts, everything just looks really, really ugly. So not a lot of good news, outside of those sectors. So, this will bring us into the portion where I'm going to go over about a dozen names of stocks that are either still green from trade alerts, slightly green, or maybe they just didn't trigger, but they look pretty good. So let's start with AMR. And again, keep in mind, we're on a weekly chart. So we're looking at these longer term trends. And so this initial entry was 138. We're currently trading at 157. I did have a second entry that triggered, I believe, briefly last week and then sold off. So we're still in at 138, right? That's down from these prior lows. And we're putting in a hammer currently this week. So keep a close eye on AMR. This is a resources company. And again, one thing I've noticed, oil and gas, resources, and some metals have been performing pretty well. And so we did see a bit of a pullback a few weeks ago, but we saw a March right back higher. So keep a close eye on AMR for the next couple of weeks. Next up is CEIX. This one, initial entry went out at 41.43. We're currently at $49, putting an inside weekend. Chart looks perfectly fine. You could see if we go back to 2018 highs at $48, we're over those highs right now. So this is still looking like a fairly bullish chart from a long-term perspective. So keep a close eye on CEIX. Next up is Antero Resources. This is a name I put out my first entry over 2170, second entry over 2617. Still looks really good. We're over the 2016 highs. We're not quite over those 2015 highs, but the chart looks like it's still, consolidating over the last 4 weeks. And you can see from prior moves, it does consolidate for a few weeks. We had a few week consolidation here. We had a few week consolidation here. We had a multi-week consolidation here. So, excuse me, we might see a little bit more consolidation in Antero Resources before it continues higher. We did come into overbought conditions. So looking for this to reset a little bit. Maybe we need this to come back down to 50 RSI, but you can see how, RSI has, come down to 50 here before moving higher, 50 here before moving higher, and then 50 here before moving higher. So maybe we need to consolidate a little bit, let RSI cool off, come back down to 50 before we get that next bounce higher. So keep a close eye on Antero Resources. Next up is Arch. This is Arch Resources. They're the second largest coal supplier in the US. Initial trade entry went out at 103. I never put a second trade idea out on this, but that was a really good call out here. You could see pretty much over these prior highs back in 2018, it's gone nothing but up. And so with this, one thing I always suggest, if you're still in these trades, use use this ATR trailing stop. That really keeps you in the trade. Right now, it's telling us 118. You know, it's a little aggressive in terms, excuse me, a little conservative. So maybe you put in a multiplier of 2. If we put a multiplier of 2, that stops us out of the trade. Maybe 2.5 for Arch makes a little more sense here, right? So you have to sometimes play with that ATR. I generally like to keep it on 2.5 to 3, unless it's a really wild stock, then certainly on 3. And if it's a very calm stock, you know, like maybe an Apple or, you know, a name like that, Microsoft, that doesn't really have a big intraday move, generally speaking, an ATR of 2 makes sense. But I think 2.5 is usually the lowest I'll go. And you can see from that breakout, that pretty much keeps us in that trade. Next up is CF. This is a fertilizer company. And, you know, because of what's happening with the war in Ukraine, I believe they are a big fertilizer producer or distributor. That's why we're seeing supply pressures on fertilizer stocks. And so you could see once we broke that $74 level, you know, now we're upwards of $95, right into that 1618 extension, right at $100. So, you know, this one definitely needs to cool off a little bit. We're sitting right on top of that ATR 2.5 multiplier. So if you're still in, you know, just keep a tighter stop loss on these, maybe under $90 makes a lot of sense. But the one thing I noticed on this, I'll zoom this out a little bit, is we had a beautiful inverse head and shoulder breakout here at $56. And the measured move from the head to the neckline brings us up to 150. So I do think that there might be more room on CF to go, but because we've made such a big move, you have to expect pullbacks along the way. Let's take a look at some shippers. This is STNG. Picked up this name. I was more familiar with Zim, which I think more of us are familiar. I've been talking about Zim for quite some time. But there were a couple of other ones, EGLE and STNG. So STNG had put out a trade alert on March 27th over 1946. That was also the break of this weekly wedge, and looked like a good trade there, bounced, back tested and bounced right off that 200 SMA. And a lot of relative strength in this name coming into its highs here at 28.25. So I think if this breaks back over 28.25, which was the prior highs back in January, or excuse me, February of 2020, this has a real shot to go back up to $40. So keep a close eye on STNG. Another name that I've talked about a lot over the last couple of months is Oxy. I missed the initial move on this, and I hesitated to put a trade alert out on it earlier because I felt like it would be chasing a bit. But, you know, I felt like it's looking really good. You know, it's flagging here. So I put a trade alert at 61.70, and we quickly stopped out of that trade. It broke out last week, and then it just, I think it was last week, I apologize, I think it was a few weeks ago, and it quickly, I think within the first week, it went right back below the trigger entry. So failed entry on that, but still watching to see if we break back over. I think this is still a good trigger to have. I think oil prices are going to continue to go back higher. Next up is XEL. This was another one I was watching, this weekly wedge. We had a breakout, retest, bounce, nice entry over 70.23, came right into the prior highs at 76.44, struggled a little bit. So what I would watch for, it's flagging right here. Watch for this flag to break out. It looks like it's trying to break out so far this week. Watch that next test of 76.44. If we hang out in that vicinity for a couple of days, watch for a breakout. Here's your next two targets up above. Here's a new one from this morning, INSW, International Seaways. Again, this is another shipping company, very similar chart to STNG, broke out, watching over 2280. We did have a false breakout, I believe, I think it was yesterday or today, and it pulled right back. So no entry on this quite yet, but it still looks pretty good. It may need to consolidate a little bit before continuing higher. Next up is LMT, Lockheed Martin. This is a trade idea all the way back from February 3rd. And again, weekly wedge breakout, nice push higher right into the 1272 extension. It's been pulling back a bit, but ATR has us at 412. Entry was at 395. We're currently forming a pretty nice wedge here, if you see, on the weekly chart. So watch for us to potentially continue to consolidate in this wedge before making a push higher. Here's another one I really like. I put this trade idea out yesterday. This is Bristol Myers Squibb, BMY. You can see why I like it. Let me take this ATR off. It's just a little distracting at the moment. Look at the prior highs here in June of 2016. We're right back there, flagging right under that level. I think if we get a breakout here, I think this breakout on a relative basis is going to be a really nice one. Don't have any targets set up quite yet, but let's just let's put some targets up here real quick. I'd be looking at 86 and then 98. It's not a fast mover. Generally speaking, when it moves, though, it moves. You can see this move here, this move here, and this move here. So I think it needs to consolidate a little bit before we make this next big push higher, but keep a close eye on BMY moving forward. Here's that ABBV chart that I was talking about. You know, initial entry was over 138, right over this high right here. You can see it has a nice cut base breakout. We hit most of our price targets. It went past our 165 price target, and now it pulled right back to 140. So it didn't pull back all the way to our entry, but it just about did 3 weeks ago. And now we're starting to bounce. So again, another example of, you know, you have to take profit on the way up, and you have to move your stop losses up along the way. You could see we would have stopped out on this trade 4 weeks ago when we broke that ATR. So really important that you're using this ATR trailing stop on your charts. If you're not, or if you don't have it, I would highly recommend, you know, getting a platform that does. I'm using TrendSpider. I know they do. I'm not sure, you know, if Thinkorswim or TradingView have something similar. Very likely they do. More than happy to help you look for that if you don't have it. But it's a really great tool that I've been using for a few years now. And it's certainly saved my butt on a number of occasions, either getting stopped out or just holding on to a trade longer and letting these winners run. Next up is JNJ. This one is triggered. It hit our first target, first two targets of 179 and 186. Look at that rejection right off that second target. And now it's pulling back. And if you put the ATR trailing stop on, it's pretty low still. So it's actually under our trigger. I generally, when it's that low, I kind of disregard it to a certain degree. And I just, you know, when I see price targets getting hit, I will move my stops up just to lock in profits, because in this market, we've just seen too many moves that have gone up and then just pulled back, and then wipe out your profits. So here's Kroger, KR. Two trade ideas on this, 45.32 and 57.18. The 45.32 and that one actually was really good right over here. We had a big push higher right to the top of our channel. The second trade entry, it really just lasted for a day or two, and it stopped out right under. So we're still looking pretty good on that first entry. Second trade entry is off, but we're coming into that center channel here, and it's holding. So KR is a grocer, not going anywhere. I would put them in the consumer staple arena. Watch for a bounce off this center channel, possible bullish engulfing this week. Got two more to go. We got Walmart. This one, another false breakout. It basically failed. We're back in our wedge here. But I do like Walmart. You know, it's just one of those names that no one is going to stop using. So just keep a close eye on Walmart if we do get back over this wedge. Certainly I will be keeping an eye on it, and I will let you know. And last but not least is Dollar Tree, right? Another, you know, type of name that when prices are getting constrained, people are going to value shop, Walmart, Target, Costco, Dollar Tree, right? And so we had this breakout over 144. We hit our first two targets, a 156 and 178. And if we go onto the daily chart, it's pretty much where my wave 5 target zone top was. We nailed this trade to the T, and now we're pulling back. So, I mean, this, although it was a great trade, pretty much should be out of this trade at this point. It was really just a textbook 5-wave move higher. I'm watching for that ABC retracement, possibly back to the 130 level, maybe back to the center channel here. Hard to say, but I'm keeping a close eye on that. So that really wraps up the broader market index review, as well as the trade idea review. I'll open up the floor to you all. If you have any questions, any chart requests, I'm going to mute myself, take a little drink of water. And if you guys and gals have anything you want me to go over, feel free to drop it in the chat below. Don't be shy. Don't be shy. While everybody's waiting, let's take a look at some ugly charts, right? Why not, right? Let's look at some tech charts and see where potentially some bottoms are going to happen. You can see here on Apple, we've broken this channel to the downside. I think did I put it on the daily chart? Yeah, we'll go down to the daily chart for these. This is the level, the area I'm watching. We had this broadening formation bottom right into our prior resistance and support zone. That's going to be between 139 and 145. So I'm going to keep a close eye in that on that level for Apple. AMD, unfortunately, this head and shoulders looks like it might be coming to fruition. So watching for a move below 82.60, targeting $72. Amazon has just been an absolute waterfall. Let's go on to the weekly chart for that. Right at that 200 SMA and didn't even bother to stop. Said, no, thank you. We're going to go for lower prices. So watch potentially Amazon to 1,600 this year. Keep a close eye on that. I'm not even going to bother with the China names. Baba and Baidu, absolute garbage right now. Datadog right to the bottom of its channel, holding on for dear life here. We are into the prior RSI lows. We broke below that. So we're seeing new lows on relative strength for Datadog. DKNG, don't even know why you're in this. You do not belong there. DocuSign, I mean, gave back all of its gains since the COVID drop, right? Here's your COVID low right there. That's where we are right now. Etsy coming into long-term support. Facebook coming into long-term support. Google, looks scary. Has a long way to drop, I think. Lululemon, watch to the 200 SMA next. Microsoft, let's take a look at this long-term trend line here. Yeah, still got a little ways to go. Netflix, I mean, wow. This is just an ugly, ugly chart. Really ugly. Neo, you do not belong in here. Get out. NVDA coming up against its long-term trend line. This is what gives me a little bit of hope, because we're having a lot of these big names coming into long-term trend support. And that also marries up with prior resistance levels turn support. So that's why I'm feeling like we're probably going to get some kind of bear market rally or counter trend move in the next couple of weeks. They're certainly tradable to the upside, but you got to be quick. You got to be nimble. ROKU lost its long-term support. SE absolutely destroyed. Shopify, I mean, wow, look at that long-term support breakdown, just disgusting. Snow, gone. Spotify, all-time lows. Square coming down to 50. Tesla, been talking about Tesla for a few weeks now. I think we're headed down to 500. That's pretty much, to me, that's a given. Twilio, let's go back up to the weekly, coming back to those COVID lows. And Zoom, I mean, disgusting, right? So yeah, I mean, no real reason to spend too much time on tech right now because there's no bottom yet. We got to wait for some sort of bounce and base to form before we even consider buying these. And if you're buying the dips, got to be careful. You really do, because these bear markets can last 6 months. They could last 12 months. We really don't know. And so that's why for the last, 5-6 months, I've really just been focusing on relative strength. There's always going to be relative strength in the market. And if you're just too biased in your conviction on tech, just zoom out on these charts and look at where they were, look at where they went, and look at where they can go back to. This can get, well, I was going to say this can get ugly. This can get uglier. All right, let's take a look at some of these names. PBR. I'll stay on the weekly chart. This doesn't look too bad. Not familiar with it, but oh, it's TWLO Brazil. Okay, yeah, I have seen this chart before. Watch for a break over $17. I think anything before that, you are getting an inbound golden cross here on the weekly. That's pretty bullish. So you might want to look at this, but it looks like head and shoulders right here. So just be careful there. ASHR. That does not look like a great chart right now. PCG. Pacific Gas and Electric. Oh yeah, this is the company that manages California's. Yeah, this is the disaster. This is an absolute disaster chart. I would stay far away from them. COTY. I think that's the beauty supply that I want to say Khloe Kardashian started or owns or something. Yeah. Yeah, this looks like it's breaking down from its range right here. So just be careful. Maybe you get a little bit of support in the $6 range. That's where we are right now. You could see prior support turned resistance, turned back to support. If we break below it, it'll turn to resistance again. DOCN. This one. Digital Oceans. Let's see. This one's below its IPO low or its IPO base. Yeah, this one I would wait until it's back over 35. Yeah. Al, you had your hand raised. If you feel free to unmute yourself if you have a question. I've got about 7 minutes to the top of the hour. Happy to go over more charts, although I feel like it's going to be an ugly 7 minutes if we did that. But more than happy to look at more charts, or if you have any questions, any specific questions, happy to go over them for you. Sector rotation process. Yeah. So, what I basically do, go to my sector overview. Where are you? Major indices and ETFs. What you have to do, it depends on what platform you have. There's a pretty cool tool in TradingView that allows you to compare sector to sector, chart to chart. And in that respect, what I would do is compare SPY to any of your major indices, and that'll show you on a relative basis if they're showing strength. If you don't, like I don't have access to TradingView anymore. I just don't use it. It wasn't worth it because TrendSpider gives me 95% of what I need. What I'm doing is I'm really just looking at the chart and seeing, is it in an uptrend? What has it been doing for the last couple of weeks? I'll look at some of the things like RSI and MACD. Let me throw MACD on there. I look for like these MACD curls and crosses. Yeah, I think, Josh, to answer your question, it was a lot easier to identify sector rotation when the market was trending. Now that the market is, kind of going sideways and down, it's a lot harder to identify the rotations because right now it's mainly staying in the energy, the oil and gas sector. Sometimes you get rotations into metals and miners, into materials, into utilities. And again, it's really just looking at relative strength versus SPY. If SPY is going down and sideways and your sector or name is going up, that's showing relative strength. And that's basically what my process is to find, the names that I've been finding every day that are tradable charts. Sure, Apple. Let's take a look at Apple real quick. So yeah, I mean, Apple, it's losing its longer term trend. We can go down to the daily chart. I did post this one earlier today. I feel like we're headed to low 130s. That would be the level that I would say, like 139, so high 130s. 139, I think, needs to hold. I think everybody and their mother and their brother and their sister has been watching 150. And now that we've lost 150, all bets are off. I think 139 is certainly in the cards. Under 139, 122 is possible. Yeah, I mean, a lot of those, a lot of these names have run really, really hard, and a lot of the charts are broken and need to reset. So love the company, love their products, love what they do. But from a valuation standpoint in this market, obviously the market is saying otherwise. And Microsoft, I haven't looked at Microsoft in a bit, but similar story. 262, it's pretty much where we're at now. I think below that, you might want to watch 245, 233, and then maybe 225. That would be where I would, yeah. No, Alfonso, from technically speaking, the bear market just started, within the last few weeks. So if we're being realistic about this, I think, there's a saying, go away in May, right? Because that's when, the summertime comes and volume starts to die out. I think if we're being realistic, if we're talking about when could the bottom be in, and again, this is all hypothetical. I don't know, because there's so much going on, as I mentioned, with inflation, with interest rate raising, with the war in Ukraine, with supply chain issues, with COVID. I don't know. I don't remember a time where there were so many macro events happening at the same time. So, it's hard to say when the bottom is going to be, right? I would never, as a trader, say this is when the bottom is going to be. But what we could do is look for signs. Look for some of these charts to start to form a base. Look for them to bounce off their lows and not sell off. Look for them to start showing relative strength against the market. Look for new market leaders to start to emerge. In a bear market, not all stocks go down. Not all stocks go sideways. There's always going to be relative strength in the market. Market makers, hedge funds, the big boys, the whales, they're going to want to make money too. And so the market's not going to go down forever. The one good thing, if we're going to be contrarian, if we're going to say, let's look on the bright side, a lot of people missed the 2020 bull run. And now we're getting the reset button hit. And yes, it might be a painful rest of 2022, but that opens us up for 2023 and 2024. Some of these names that, have been absolutely destroyed, but have amazing, products, amazing companies like the Shopifys of the world, they're not going anywhere. And, they were in the thousand, like Shopify was over $1,000. Now it's under 300. That's a company I'm going to be closely watching. I want to own that name again. I'm not buying it here because it can continue to drop. But if I'm looking 5 years down the road, maybe it's back at 1,000 in 5 years, right? It's another, 250% move higher. I'll take that return all day, every day. The problem is most people can't exercise patience. Most traders fail and lose money because they're not patient, because they want to trade every day. You have to wait for the right time to trade. You have to watch for the right tickers and the right charts to trade. This market's going to be tricky. I'm not going to lie, but it's not going to be impossible to trade. But what you have to do is adjust your expectations and adjust your strategies according to what the market is offering. We're not going to get, a lot of charts breaking out, with big moves. We might have to settle for 5%, 7%, 10% winners. We might have to take profits quicker, and that's okay. If you want to trade in this market, you have to adjust your expectations based on what the market is dictating. And that is what the market is dictating now. But think about it from this perspective also. The market is not going to be like this forever. And if you learn how to trade during a bear market, if you learn how to trade when the market is going sideways, how much easier is it going to be when the market gets easier to trade? How much easier is it going to be when the market starts trending back higher? History has shown us that the market continues to go high, right? We can go and look at SPY, right? And we can go and look at the monthly chart, and we can go all the way back, right? It's higher than it was in 1993, right? It's higher than it was in 2009. It's higher than it was in 2000. But there's always drawdowns, right? And sometimes those drawdowns can last 6 months. Sometimes they could last a year, right? Look at the 2001 dot-com bubble burst, the 2008 housing burst, the 2020 COVID bubble, right? You have to put these things into perspective. If you quit and you walk away now, you're never going to be successful at trading. Now is the time to double down, and not double down in your trades, but double down in your education. If this is something you really want to do, you need to spend the time, because the market goes through cycles. History has shown us that. But the better you are when the market is tough, the better you're going to be when the market gets easier. And trust me, that is just around the corner. And it might be 6 months. It might be a year from now. I can't give you that answer. But I do know that, bears go and they hibernate, right? and then they come out and they make a bunch of noise. And guess what? When the winter comes back around, they go to hibernate again. These bears will go to hibernate again, and they'll be in hibernation for a while. We just need to hold out. We need to exercise patience. This market will come back. We'll all be ready. But in the meantime, there's still going to be relative strength out there. And that's my job to find it. And it's your job to follow up on that and do your own due diligence and see if the trades are right for you. So that's about all I've got for now. I wish I had better news, right? But this is just the reality of what the market is offering right now. Just really quickly looking at this monthly chart. Look at this. This is from 2010. This is a 12-year run, right? We're coming back into that channel, and maybe we're down to 340, right? Look at what the center channel acted as support here and support here. We did lose it here, came back to that bottom, but once we came back through that, this is COVID here, we had a nice run higher. So maybe we need that reset. Maybe we need to hit that big reset button and go down to 340 on SPY. I don't know. Maybe we reverse at 380, 383. which is what I think is more likely. But again, we don't know. But what we do know is we need to be prepared either way. And that's my job. So I appreciate you all for being here with me. I know it was a small crowd. I was expecting a small crowd. I know a lot of people are just dejected with this market. So, but I'm still here doing my homework every single day for each and every one of you. And I hope that, in the coming, weeks and months, we'll find some nice winners. We'll find those hidden nuggets of gold in a sea of coal, and we'll all make some money together, and we'll ride out this bear market, and we'll get right back to business as usual. So appreciate you all being here with me. Thank you so much for your support, and I look forward to seeing you all again in 2 weeks, and certainly you'll be hearing from me tomorrow morning. Take care, everybody. Have a great rest of your evening, the rest of your day.